In day-to-day business, buyers and sellers rarely transact at the printed or quoted price. Discounts are commonly used to increase sales, maintain long-term relationships, and encourage early payment. However, not all discounts are treated the same way in accounting. Some discounts affect the value of goods itself, while others affect only the final settlement of money. This video clearly explains two important comparisons. First, pre-discount, trade discount versus cash discount, and second, discount received versus discount allowed. We will understand which discount is recorded in books and which is not, which account is debited or credited, and why that accounting treatment is followed, using practical examples. Meaning of trade discount. A pre-discount, commonly called trade discount, is a reduction in the listed or marked price of goods. This discount is given before the sale is finalized, usually to wholesalers, bulk buyers, or regular customers. The key idea is that a trade discount decides the selling price itself. Once the discount is applied, the reduced price becomes the actual price of the goods. Accounting treatment of pre-discount. Trade discount is not recorded in the books of accounts. This is because accounting records only the final agreed value of the transaction, not how that value was arrived at. The invoice itself shows the net price after trade discount, so there is no separate loss or gain to record. Practical example of pre-discount. Suppose a seller lists goods at Rs 10,000 and allows a trade discount of 20%. The buyer is billed only Rs 8,000. In the books, sales is recorded as Rs 8,000. Purchases is recorded as Rs 8,000. The Rs 2,000 trade discount is never recorded separately because it is not an expense or income. It only adjusts the selling price. Meaning of cash discount. A cash discount is a reduction allowed for early or prompt payment. It does not change the value of goods sold but affects how much cash is finally paid or received. Cash discount is a financial incentive, not a pricing decision. Accounting treatment of cash discount. Cash discount is recorded in the books of accounts because it arises after the sale is already recorded and directly affects profit. For the seller, it is an expense. For the buyer, it is an income. Practical example of cash discount. Goods are sold for Rs 8,000 on credit. Terms are 2% cash discount if paid within 10 days. If the buyer pays early, cash paid is equal to Rs 7,840, discount is equal to Rs 160. Here, the sale value remains Rs 8,000, but Rs 160 is treated as a separate item in accounting. Key difference summary understood through concept. A pre-discount or trade discount affects the price of goods and is therefore not recorded separately. A cash discount affects the settlement of money and is therefore always recorded in the books. Discount received versus discount allowed. Now let us clearly understand how cash discounts behave from both sides of a transaction. What is discount allowed? Discount allowed is the cash discount given by a seller to a customer for making early payment. From the seller's point of view, it is a loss or expense because the seller receives less cash than the amount due. Why discount allowed is debited? In accounting, expenses and losses are debited. When a seller allows a cash discount, he sacrifices part of his receivable. Therefore, discount allowed is treated as an expense and is debited to the discount allowed account. Practical example of discount allowed. A customer owes Rs 8,000. The seller allows a cash discount of Rs 160 for early payment. Cash received is equal to Rs 7,840. Discount allowed is equal to Rs 160. Journal entry in seller's books. Cash account is debited because cash comes in. Discount allowed account is debited because it is an expense. Customer's account is credited because the receivable is settled. This clearly shows why discount allowed is a debit item. What is discount received? Discount received is the cash discount received by a buyer from the seller for early payment. From the buyer's point of view, it is a gain or income because he pays less than what he originally owed. Why discount received is credited? In accounting, incomes and gains are credited. Since discount received increases the buyer's benefit, it is treated as income and is credited to the discount received account. Practical example of discount received. The buyer had to pay Rs 8,000 but paid only Rs 7,840 due to cash discount. Discount received is equal to Rs 160. Journal entry in buyer's books. Supplier's account is debited because liability is reduced. Cash account is credited because cash goes out. Discount received account is credited because it is income. This explains clearly why discount received is a credit item. Combined logic, one person's loss is another person's gain. The same rupees 160 is an expense, discount allowed, for the seller. An income, discount received, for the buyer. Accounting always reflects the point of view of the business maintaining the books. Final conceptual clarity for students. Trade discount or pre-discount is not recorded because it only determines the selling price. Cash discount is recorded because it affects profit or income. Discount allowed is debited because it is an expense or loss to the seller. Discount received is credited because it is an income or gain to the buyer. If students remember this logic rather than memorizing entries, accounting becomes simple and practical. Understanding discounts correctly is essential for passing exams with accuracy, avoiding journal entry mistakes, and handling real-life business accounting. Once the logic behind price adjustment versus payment incentive is clear, discounts stop being confusing and start making complete sense.